Hi everybody, this is Chapter 9. Chapter 9, we're going to be covering the topic of fixed and intangible assets. This is a continuation really of the asset side of the balance sheet. We've already talked about current assets, which are cash, accounts receivable, and inventory. And now we're really moving into longer term assets. And really the bulk of long-term assets are going to be typically what do we call fixed and intangible assets. So what we're going to cover in this chapter are, first of all, fixed assets. We're going to learn what fixed assets are, how we're going to record the cost of the fixed asset, what happens when we have a subsequent expenditure, how do we classify that as either a fixed asset or an expense, how are we going to depreciate our fixed asset using three generally accepted accounting methods. And then finally, what do we do when we dispose or sell a fixed asset? And then our final topic will be how we record and amortize intangible assets. So that'll be a separate topic. So first of all, coming back to fixed assets, typical examples of fixed assets would be, and I can just write a couple here, obviously land, buildings, that would include warehouses, equipment, vehicles, so that could be delivery trucks, that could be other vehicles that are used, furniture and fixtures, could also include, as part of equipment, computers. We'd also include software as part of that. So a lot of those longer term assets that are going to be long-lived, that are going to be around for, generally speaking, greater than a year. So what are some characteristics of fixed assets? I've got those listed here. So generally speaking, with the exception maybe of software, but generally speaking, they're physical and they're tangible assets. So we can touch them. They are tangible in nature. That's really the first characteristics. Typically, they're owned, although there are certain situations in which we can lease assets and where we have the ability to purchase them at a reduced price, or where we've essentially paid for the asset and it's more of a financing type transaction. That would also qualify as a fixed asset. That would be something it would be covered in intermediate accounting, but generally speaking, fixed assets are owned assets. They're used in the course of business, and this is very important because not only are they used in the course of business, but they generate revenue. Okay, so that's obviously a critical component and a critical concept as we think about depreciation a little bit later. So fixed assets are absolutely are essential in generating revenue, either directly or indirectly for the company. Again, they're long-lived, which means that typically speaking, greater than 1 year. And they're not held for resale, so they are not inventory. Okay, so assets such as vehicles, for instance, we wouldn't be talking about vehicles for a car manufacturer. That would be inventory for, let's say, General Motors. The vehicles would be inventory for them. They're building vehicles for resale. We're talking about vehicles for someone maybe like Walmart. They would use those vehicles to transport their inventory. So that would be part of fixed assets. So let's talk about sort of how we're going to classify and how we're going to determine what is a fixed asset and what is not. So we have some dollar expenditure. So we have some sort of expenditure of money. And if that expenditures related to something that is going to have a life of less than a month, that of course is going to be classified as an expense. Okay, so if we pay for 1 month's rent, or we pay the electricity bill, or we pay for obviously somebody's wages, something like that would be considered an expense. So we're really interested in an expenditure that's going to be greater than a month, and now what we have is what's called an asset. And again, that's nothing new. We've been talking about that since chapter 1. So now we know we have an asset. The question is it less than a year or greater than a year? Less than a year would be a short-lived asset, and this would really be just a current asset. So we're talking about, let's say, a prepaid insurance, prepaid rent, accounts receivable, something like that, supplies. Typically those are consumed within a year, and so what we have is really a current asset. So we're really looking at things that are over a year, which are a long-lived asset. If it is used in the course of business, as we mentioned earlier, that is a fixed asset. And it's classified on the balance sheet as a fixed asset. If it is not used in the business right now, let's say it's land that we're holding for future use, or it's an investment in another company, something like that, we're going to classify that as a long-term investment on our balance sheet. So that is in a different category of assets apart from fixed assets. All right, so now we know what a fixed asset is. We know how to classify it. We know the characteristics of it. So now comes time to determine how we're going to record the asset. So if we look at just a T account, and here we have some kind of asset. So let's say we have equipment. And the question is, what is going to be the cost of that equipment? What's going to be the debit to that equipment account? Now, obviously, the cost is going to include the purchase price of the equipment, but it's also going to include, say, the tax that we would have to pay, sales tax on purchase of that equipment. If we had to pay to deliver that equipment to our factory, that would also be included as a debit to that account. So any delivery costs. If we had to install that equipment, the cost of the installation would be a debit to the equipment account, credit to cash, let's say. So installation would also be part of that. Debit. Installation. And let's say we even had to go ahead and test the equipment. We had to run some product through that, making sure it's okay. We had to hire some people to do some testing, some engineering services, things like that. We would not debit engineering service expense. We would debit equipment. We would debit the asset account for the costs of doing that. So even testing, let's say. Okay? So all of these expenses, all of these costs, I should say, would be not included as expenses, but would be debited to the equipment account and be part of the cost of the equipment. So what we're going to call cost and what we're going to include as the debit are going to be all costs that are necessary to get the asset ready for its intended use. And so again, you can see that all those costs are absolutely necessary to get that asset ready for its intended use, which is to say it's a production line. We have to pay for it. We have to pay the tax. We have to pay the delivery to get it to our location. We have to pay to install it, to hook it up. We have to test it. We have to make sure it works properly. All of that is necessary to get that asset ready to go to start producing our product. Therefore, all of those costs would be a debit to that equipment account. So if all those costs total $1,360, for instance, then our debit to equipment would be $1,360, and that would be the cost of our asset. So what happens if we have a subsequent expenditure? So we put the asset into place, and at some point down the road we have a subsequent expenditure. Well, first of all, we have to look to see what type of an expenditure that is. If it benefits the current period only, so let's say this is let's say it's a truck that we purchase, and we go ahead and put some gas in the truck, or we do an oil change, or we repair a flat tire. In that case, what it would end up being, if it's only going to benefit the current period, it's going to be classified as an expense. And this is, generally speaking, a repair and maintenance expense. Okay? That we call a revenue expenditure. If it benefits future periods, in other words, more than just the current period, it would be classified as either an improvement in the asset, it would either improve the asset, or it would extend the life of the asset. And we'll go through a couple of those examples in a moment. In that case, it's a capital expenditure. And it's basically going to be recorded as an asset. So for instance, let's say it is a truck. Let's say that we go ahead and install a wind deflector so that we get improved gas mileage, and that saves us money. That would be an improvement. So that cost would be a debit to the asset account, to the truck account. Let's say that at some point in time we overhaul the engine, and so now we can drive it for another 100,000 miles. That would extend the life of the asset. In that case, what we're doing is we're going to debit accumulated depreciation, which is another asset, contra asset account, and that would be extending the life. So both of those type of costs are going to affect asset accounts, as opposed to changing the oil, fixing or repairing something that's broken, doing something that doesn't improve the asset, make it more efficient, make it less costly to operate, or it doesn't extend the life of the asset. If it's just to really maintain it and to keep it operating, then it's going to be classified as an expense. So debit, repair and maintenance expense, credit cash. If it's going to go ahead and improve the asset, then debit the asset, debit truck, credit cash. If it's extending the life, debit accumulated depreciation, truck, credit cash. Okay, so those are the differences in subsequent expenditures. And then what happens is we continue to just depreciate or make adjustments in depreciation, which we'll come to later. All right, but for right now, cost, we're going to include all the costs that are necessary to put the asset in, get it ready for its intended use. Okay, and then if we have a subsequent expenditure, we determine whether that's an expense of repair and maintenance to keep the asset functioning as planned, or if it indeed changes the character of the asset to either improve it, make it more efficient, make it less costly, or if it extends the life, in which case now it's recorded as part, as an asset, an adjustment to the asset accounts.